Have you ever wondered what it would be like to be your own bank? I mean, a world where financial services are open to literally everyone, 24/7, with no stuffy middlemen taking a cut. Well, this isn't some far-off sci-fi future. It's happening right now in the wild world of decentralized finance, or DeFi. So today, we're going to jump headfirst into this exciting and, yeah, pretty risky new frontier. We're going to break down the essential building blocks, stablecoins, the whole DeFi ecosystem, and the crazy world of yield farming. All right, let's dive in.
Just take a second and really think about that. What if your bank wasn't some brick-and-mortar building on a street corner? What if it was just code? A global network that anyone with an internet connection could tap into. A financial system that never sleeps, never has holidays, and is open to every single person on this planet, no matter who they are or where they're from. This is the radical, world-changing promise of DeFi.
Okay, so to really get our heads around this, we need to build our knowledge from the ground up, right? So here's our game plan. First, we'll start with the absolute foundation, stablecoins. Then, we'll explore the whole ecosystem they power, DeFi itself. After that, we get to the fun part, the action, with yield farming. But then, we got to talk about the big catch, something called impermanent loss. And finally, we'll weigh the reality, the massive risks versus the potential rewards. It's a journey, so let's get going.
So let's kick things off with part one, understanding stablecoins. Look, before we can even dream about those crazy high returns and cool financial gadgets, we need something solid to stand on, a stable foundation. Because without these, the rest of the DeFi world would just be way too chaotic to even function.
So what on earth is a stablecoin? Well, in the simplest terms, it's a crypto token that's designed to hold a steady value. Most of the time, it's pegged, or you can think of it as linked, one-to-one with a real-world currency, like the US dollar. So one stablecoin is supposed to always be worth $1. You can call it a digital dollar. It gives you the speed and the global nature of crypto, but with the price stability we're all used to with normal money. It's really the bridge between the old financial world and the new one.
Now, why did we even need this bridge in the first place? The answer is just one word: volatility. I mean, cryptocurrencies like Bitcoin and Ethereum are famous for their absolutely wild price swings. A 10% jump or a 10% drop in a single day? That's just a Tuesday in the crypto world. Now, that might be thrilling if you're a trader, but it's a total nightmare for, actual financial stuff. You wouldn't want to get your paycheck in something that could be worth 20% less by morning. Stablecoins were invented to solve that exact problem.
But how do they actually stay stable at that $1 price? Good question. There are basically two main ways they pull it off. On one hand, you've got collateralized stablecoins. These are backed by real assets. Something like USDC is pretty straightforward. For every one USDC token, there's a real US dollar sitting in a bank account somewhere. Others, like DAI, are backed by a whole bunch of other cryptocurrencies locked away in a digital vault run by code. Then you have the other side of the coin, algorithmic stablecoins. These aren't backed by anything. Instead, they use some seriously complex computer programs to automatically create or destroy coins to try and keep the price at $1. As you can probably guess, these are highly experimental and incredibly risky.
That algorithmic idea sounds brilliant on paper, doesn't it? A self-correcting money system? But in practice, it is proven to be extremely fragile. And there is no better or more painful example of this than the story of the Terra ecosystem and its stablecoin, UST. What happened here sent a shockwave through the entire industry.
The scale of this failure was just mind-boggling. Back in May of 2022, the whole Terra/UST algorithmic system just imploded. See, the stablecoin, UST, was linked to this other token called Luna. When people started to lose confidence and a sort of digital bank run began, the algorithm went haywire trying to defend that $1 peg. It started printing and selling insane amounts of Luna, which flooded the market and crashed its price. This, of course, caused even more panic, which made the algorithm print even more Luna. You see where this is going. It created this vicious feedback loop. They call it death spiral. The end result? As the quote says, nearly 45 times billion dollars just vanished in about a week. Both tokens went to basically zero, a total wipeout.
So we have these digital dollars, these stable coins, that give us a reliable foundation. And that leads us right into part two, exploring DeFi. Okay, so now that we have stable money on the blockchain, what can we actually do with it? Well, the answer is a whole lot. Welcome to the sprawling, innovative, and kind of crazy ecosystem of decentralized finance.
DeFi is really just a catch-all term for all these financial apps being built on blockchains. The whole point is to rebuild our traditional financial world, lending, borrowing, trading, insurance, all of it. But to do it in a way that's open to everyone, without needing big, powerful middlemen like banks or brokerage firms. Instead of relying on institutions and endless paperwork, DeFi runs on something called smart contracts, which is just code that automatically handles all the transactions.
Now, one of the coolest and most powerful ideas in DeFi is this concept people call money Legos. Seriously, because all these different financial apps are built on the same public blockchain, they can be stacked and combined in all sorts of creative ways, just like Lego bricks. So a lending protocol like Aave can be one piece, a decentralized exchange like Uniswap can be another, a yield aggregator, which is basically a robot that hunts for the best interest rates for you, is another piece. And here's the magic. Developers can snap these existing Legos together to build brand new, totally innovative financial products at a speed that is just unthinkable in traditional finance. This is what drives the insane pace of innovation you see in DeFi. This whole idea of stacking Legos brings us directly to part 3, demystifying yield farming. So if DeFi is the ecosystem and stablecoins are the money, then yield farming, that's the action. This is how you actively put your crypto to work inside all those different DeFi protocols to try and generate returns.
At its heart, yield farming is just the crypto version of earning interest at a bank or getting dividends from a stock. You take your crypto assets, whether they're stablecoins or something else, and you either lend them out or stake them in a DeFi protocol. Staking is just a fancy word for locking up your crypto to help an app function. In return for providing your capital and helping the system work, the protocol rewards you, usually with more cryptocurrency. Simply put, you're making your crypto work to earn you more crypto.
So let's walk through the most common type of yield farming, which is being a liquidity provider. First, you need two different cryptos, but in equal dollar amounts. So let's say $500 worth of Ethereum and $500 worth of the USDC stablecoin. Step 2, you deposit both of those into what's called a liquidity pool. Think of this pool as just a big pot of money that other traders can use to swap between ETH and USDC. Step 3, when you deposit your money, the protocol gives you a sort of digital receipt, a special token called an LP token that proves you own a share of that pool. And finally, you start earning. You get a cut of all the trading fees from that pool, and a lot of the time you can take that LP token and stake it somewhere else to earn even more rewards.
It sounds pretty great, doesn't it? Earning passive income on your crypto. But there's always a catch. And this leads us to the single biggest, most confusing, and most important risk in all of yield farming. Let's move to part 4, the catch, impermanent loss.
Okay, so impermanent loss is a really tricky concept, so let's try to break it down. It's not really a loss in the way we normally think about it, where you look at your account and the number is smaller. It's much better to think of it as an opportunity cost. It's the difference in value between your money in that liquidity pool versus what it would have been worth if you had just left it alone in your wallet. This gap appears whenever the price of one of the cryptos you deposited changes compared to the other one.
An example makes this way easier to understand, so let's go through it slowly. Let's say our friend Alice deposits 1 Ethereum, which is worth $2,000, and 2,000 USDT stablecoins into a liquidity pool. Her total initial investment is $4,000. Now let's say the price of Ethereum goes on a tear and shoots up to $3,000. Well, the pool is programmed to keep a 50-50 value balance between the two assets. So smart traders will come in and buy the now cheaper ETH out of the pool and sell USDT into it. This automatically rebalances the pool, and it changes what Alice owns. When she decides to pull her money out, she might find she now has about 0.8 ETH and 2,400 USDT. The total value is $4,800. Hey, that's an $800 profit, not bad at all. But, and this is the crucial part, what if she had never put her money in the pool and just held it? Her 1 ETH would be worth $3,000, and her 2,000 USDT would still be worth $2,000. Her total would be $5,000.
That $200 gap, that is the impermanent loss. It's called impermanent because if the price of ETH fell all the way back to $2,000, that loss would technically disappear. But because she withdrew while the prices were different, that opportunity cost is now a real permanent loss for her. Now, hopefully the trading fees she earned along the way were more than $200 and she still came out ahead, but you always have to account for this risk. You made a profit, sure, but less than you would have if you just sat on your hands.
Okay, this brings us to our final section, where we tie everything together. Part 5, the reality, risks versus rewards. The chance to earn high returns in DeFi is very real, but it all happens in what people rightly call the Wild West of finance, and that comes with some very, very real dangers.
You absolutely have to know what you're getting into. First, there's smart contract risk.
One tiny bug in the code, and a hacker can exploit it and drain every dollar from the protocol in minutes. Then you have rug pulls. These are just straight-up scams, where shady developers launch a project, get people to invest, and then just disappear with all the money. We just spent a lot of time on impermanent loss. Then there's regulatory risk. Governments around the world are still trying to figure out what to do with this stuff, and new rules could pop up overnight. And of course, there's just plain old volatility risk. The reward tokens you're earning could themselves crash to zero, making all your effort worthless.
And yet, after hearing all of those scary risks, you might be thinking, why on earth would anyone do this? Well, it's because despite the dangers, DeFi offers a really powerful vision for the future. It's a vision of a financial system that isn't controlled by a handful of giant corporations, but one that's open, transparent, and accessible to anyone on Earth with an internet connection.
So there you have it, the foundation, the ecosystem, the action, and the risks. This new financial frontier is here, and it's open for business. But its incredible promise is matched by equally immense risk. And that leaves us with the single most important question you have to ask yourself before you ever put a single dollar in. Have you done your own research? Because in this world, that's not just a cute saying, it's the only thing that matters. The power is in your hands, but so is all of the responsibility.